Rajat, do you expect Reliance to bounce back in the second half?
Well, that's a difficult call to make right now. It's almost more than 2 years in a row when the underperformance is continuing, and honestly, we have been a bit surprised by the underperformance of the last couple of months because first, the refining margins have remained extremely strong, and second, we thought that after the deal with BP, there would be some respite coming on the E&P side. But it seems that till the time you don't see any more clarity coming on the E&P, and second, the avenues in which this large cash flows that they are going to earn is getting deployed, you will see this stock being performing in line with the market. So I think the key for Reliance is first they need to stem down this negative news flows around E&P, and second, investors will need to feel confident that this large cash flow which is coming in over the next 1 to 2 years is going to deploy into something which will earn more than what investors have been thinking right now.
Rajat, IT is emerging as the new defensive pocket. What would be your pecking order when it comes to the IT stocks?
Well, in IT, this quarter was a bit disappointing from the sector point of view because we entered the earnings season with a lot of optimism. Infosys, we know what happened. TCS was just about in line and the stock reacted negatively. Wipro was disappointing. It was just HCL Tech, and even Cognizant, when they reported the numbers, the stock at one point of time was down almost 8 to 9%. So I think the expectations have been running very high. We don't view IT as a defensive because we think that given the kind of growth expectations that one has built in and the stocks trade at 20 to 23 times, they remain as exciting if global growth rebounds and as vulnerable if global growth were to slow down. So we do not categorize IT in defensive. Right now in IT, I think again at best you can be neutral because you had a phenomenal performance coming from the likes of TCS over the last couple of years, which has led to not just to a massive re-rating of the stock, but also lead to a very high expectations of this growth continuing in FY12 and 13.
Rajat, Indian markets currently are trading at a premium to other emerging markets, but it is evident that the investment cycle and the consumption cycle is slowing down. Do you think in coming months the premium for Indian markets could narrow down?
I think that process has been underway for a while now. As I mentioned, that last 6 quarters our market is more or less flat, while the earnings over this 6 quarter would have grown by 25-30%. In my view, if next 2 quarters we are able to hold on to the current levels, and if we add 2 more quarter of earnings, from a 14.5-15 times we will start trading at 13.5 times, which probably would mean that the premium over the other markets will contract significantly. So it's a question of another 2 quarters of flat performance for the market, leading to a de-rating on the multiple side, and I think things will start looking good hopefully then.
So in terms of a sectoral allocation, what are your current overweight recommendations and underweight recommendations?
See, right now we don't have any strong sectoral allocations right now because we think this is a very range bound market, so it makes so the best way to play this market is to focus more on stocks. So for example, in financials, we think ICICI Bank continues to do very well and should outperform not just the sector but the market also. In autos we have M&M which again looks quite good. So similarly, Bharti is another stock which we think is making a comeback now after being flat for 4 years. It's set to deliver some outperformance now. So we are being very stock specific both in the large caps and the mid caps right now. Till the time we don't get clarity on both the domestic business conditions and the global environment, it's very difficult to take a strong sector call.
Okay, Rajat, good to have you on the show. Thanks very